Everyone to this week's edition of the Louisville Real Estate Investor Meetup Group. Always great to see all of you. As far as what we do as a group, we started back in April of, I want to say April or June, May of 2019. And prior to the pandemic, we were meeting in person at the Manhattan Project here locally in Louisville. And then we transitioned to an online component. And now that we've been starting to meet in person, we're also doing a virtual component in the middle of the month where we get to reach out to awesome speakers like Ashely. And then obviously we also do the in-person event at the end of the month here at the Manhattan Project. It's a restaurant here locally in Louisville, but really excited to see everyone. Luke, do you have anything you wanted to kind of touch on prior to us getting started?
No, I just want to say, thanks Ashely for coming on. I know taking time out of your day and away from family and all the rest of it is, there's a lot of stuff you could be doing, and we really appreciate you spending it with us. So thank you. Thank you.
Absolutely. Thank you for the opportunity.
Definitely. No, and I've had several people reach out to me saying they were excited for this one. So I know we're going to gain a lot of value from our conversation. So if you could tell us a little bit about yourself, just give us a little background, a high level overview of who you are and what got you into real estate.
I started in real estate in 2000 and I guess it was 2008, 2007, 2008, around there. Because my husband and I were looking for a way to diversify our retirement strategy. We weren't firm believers in the stock market, and we were looking into alternative investments, and we stumbled upon bigger pockets, to be honest. So we started just diving into bigger pockets, and we were hooked. And we started with house hacking and short-term rentals. That would be, like our toes in the water, so to speak, into real estate. And we both were still working our own jobs. And then not too long after that, we bought a couple more rentals, but then not too long after that, I transitioned into real estate full time. I started a high-end flipping business with my father. And we focused on flipping houses outside of the Philadelphia region. So in the suburbs of Philadelphia, there's an area called the Main Line, and we focused on buying houses there. We weren't focused on volume. We were focused on the quality of return. So that was very different than what everyone else was doing within our market, especially because we were targeting high-end flips. So in terms of swimming in a blue ocean versus a red ocean, we were definitely swimming in the blue ocean. We were buying more expensive properties. So we were, instead of competing against 40 other investors, we were competing maybe against 2 or 3. We weren't competing against homeowners because there was enough supply on market that homeowners were not interested in rehab properties, especially ones that needed full gut rehabs. So we could get them at a major discount. And my father is a general contractor, so we had the wherewithal and knowledge to be able to execute. And I had a property management type background before I came from pharma, and I worked in project management. So it was very, positioned well to lead the project management component of it. So my father and I continued with that business. And then I lived overseas for 4 years. That's actually when we started the business, ironically. But once we came back home, which was about 4 years ago, we transitioned into large commercial or large multifamily properties. And that's what we do today. So we've done a little bit of everything. We also have invested in notes and precious metals and a few other things too, but our primary focus in active investing has all been centered recently around commercial real estate.
Cool. That's awesome. You said short-term rentals, and I've got short-term rentals myself. You don't still have those anymore, do you?
No, we actually, we did extremely well with them. And looking back, I'm kind of shocked that we didn't say why, let's jump on this train, because just to put it in perspective, what we did is, my husband was a professional ice hockey player. So he played 9 months out of the year. And that's when we house hacked. So his teammates would live with us. And then we converted that property into a short-term rental over the summer. So the first 3 months we made 20,000. The second year we made 30,000. The third year we made 40,000. And then we had someone who wanted to long-term lease it from us, and he had signed with another team. So we thought it was a perfect opportunity. We didn't have to constantly look for guys to live in the property and then short-term rent it. In the summertime, we would get this long-term lease in, and then that person, about 6 months in, wanted to buy it from us. So that's how we exited from doing the short-term rental side of the business, but we've done it in some other smaller capacities as well. So
cool. And so it sounds like you've done both single family and multifamily investing at this point. Living in Europe or living abroad, was it Europe that you lived?
I lived in Sweden, Switzerland, Latvia, Germany, and Russia.
Wow, that's awesome. That sounds very fun. But when you came back, you obviously chose multifamily. So could you talk about, I guess, from your experience, what are some of the good things and the bad things about single family versus multifamily, and why you chose that direction once you came back?
Yeah, so I'm a firm believer that you can be successful in any real estate asset class, which is why you hear of so many different successful people in these different asset classes. So every asset class, in my opinion, has strengths and it has weaknesses. With regards to the single family side, specifically, let's talk about flipping, I guess, as opposed to small rentals, single family rentals. On the flipping side, you have these surges of capital, which is fantastic, but it's also heavily taxed business strategy. It also too is very labor intense, and the means in which we were doing it, when you do high end flipping, it's not a set it and forget it plan. So what I mean by that is people who focus on volume, it's very easy to buy bulk supplies of flooring, tile, fixtures and finishes, because ultimately you're doing volume. You're probably at an ARV in the 200 to 300 range. And you can develop at the masses at the level. I mean, think about it. That's what builders are able to do. They have a builder grade home and they're able to mass produce it. When you get into million plus homes, you need to have more character and more style, and they have to be individualized. So that type of business strategy is very hands-on, because you have to be up with the latest and greatest trends and do some things that are super expensive, and then other things that look expensive but maybe are not as expensive. So that is a different business than, for example, on the multifamily side, where you're not really as tapped into doing these high-end renovations, but you're able to do more of, the stock type renovations. If you're doing like a value add play. The thing with large multifamily is, to me, flipping is a get rich. Large multifamily, in the way that we do it, is to build wealth. And it's a different type of strategy. There are major tax incentives. One great thing with multifamily is apartments typically trend, if you look at rents, they typically trend with inflation. We are in a market in which we will definitely see inflation in the next coming years, if not sooner. So with rents trending with inflation, that positions us very well for apartments to be the asset class for which we're pursuing. I also think too, in terms of the benefits and the negatives to large multifamily, is you can leverage people, resources, and you can leverage capital. So with capital, for example, your purchasing power, once you get into commercial loans, is so much greater than residential loans. So you have that component. You also have the passive investor component that can fund the equity portion of the acquisition, which makes it very advantageous. Of course, you can do that on the single family flipping side as well, but that structure looks a little bit different. Normally it's not in a syndication model, and normally it's not a passive investor unless you're doing a hard money loan or maybe a private money lender. But most of the time it's someone who, wants to be more tapped into what you're doing. So that can be a hindrance on your operations. Either way, though, I think both are really good strategies. And I also think too, that with single family rentals, I know a lot of people who make a lot more money than me, and they have less in terms of total units because they haven't had to syndicate and they're not giving away a huge portion of the cash flow. So if you're able to position yourself where you're executing the BRRRR strategy, for example, that's a very great way to build a large portfolio where you don't have to partner, or maybe partner in a smaller capacity.
Yeah, no, I agree. And I think some parts of me feels like that's one thing that's been holding me back is I do the BRRRR. That's all I do basically. But at the same time, I've had that struggle of being able to grow to some degree because I don't partner. So I guess it's a catch 22 to some degree. You're limited by what you can do without partnering, but at the same time, you don't give away the equity piece or the cash flow that you would give to your other syndicated partners. But I am fascinated by the bigger money because, like you're saying, bigger numbers on the bigger deals.
Yeah, and I'll even add to that because, like you said, on the multifamily side, in the commercial realm, the way you value property is different than in a single family setting, for example. Yeah. Typically, you're going to be looking at the net operating income. So if you can you can pretty much force appreciation on a lot of these commercial properties, and then at the time you sell the property, that's when Ashely you would realize the gain that you had forced over the course of you being holding that property. So that's an added benefit of it. So yeah, I agree. And I'm nowhere near where Luke is yet. I actually have a fourplex. I started house hacking. That's how I got into investing. And so I've been on the commercial end as a broker for a little while now, but I'd like to eventually get more into the commercial realm as far as multifamily and even in the retail and industrial properties as well. So
I think with large multifamily, the difference is you're buying a business, which comes with real estate. And when you're buying a single family, you're buying real estate. To your point on controlling the evaluation, you're really at the liberty of what the comps are selling at. Whereas when you buy large multifamily, you can have two identical properties across the street from each other, even next to each other, it doesn't matter, built by the same builder, same vintage. And one property could be worth millions more than the other property because of the fact that the operations are so much stronger. And that is something that really attracts me to multifamily. I think in part because I know I'm good at operating large multifamily properties. So to me, I get a kick out of finding ways in which I can multiply people's returns and our investment. I was talking to someone yesterday where I mentioned that too many people focus on increasing the evaluation, and my objective is increase the equity you have in the deal by increasing the evaluation. If you focus on your equity in the deal as opposed to just the evaluation, which is a whole change in concept of thinking, right? Because if you're able to do a renovation on, give that example that I gave before where two identical properties, if I'm doing a renovation on both properties and I can lower the cost on the renovation on property A versus property B, then property A means that I'm going to have more built-in equity on that property if they're both identical properties. So that's one other thing I really love about multifamily, just because I came from that construction mindset background with my dad heavily influencing my ability to operate these properties. Focusing on which renovations you do by unit based off of, the cost of the renovation, and then multiplied by the cap rate, that dictates to me whether or not I renovate one unit versus another. And I think that speaks to constantly increasing your equity in the deal.
Definitely. No, that's some great advice. So let's take you back to your first multifamily deal. Can you kind of walk us through what your logic was when you were analyzing the deal, and then as you purchased it and kind of worked on it to try to maximize its revenue? How can you kind of walk us through that process?
Yeah. So my first general partnership opportunity came by way of someone who was a mentor to me, and I led with my skill set. I think a lot of people lead with what their deficit is, but I lead with my skill set, saying that I'm very good at managing construction and saying, how do I get into large multifamily? And I was having this conversation with my mentor, and he said, well, shockingly enough, I have a project under contract right now. It has a $2 million CapEx. He knows nothing about construction. He was going to outsource construction management. And all of a sudden, here I am leading with my value, and he sees that value and says, do you want to partner with me and lead construction management on this property? Which of course I do. I wanted to, this was like perfect storm. So I was able to get into that situation. And then in terms of identifying how to execute it, I was very green at the time, very open to learning as much as I possibly could because I didn't know enough. I went from doing like single rentals to all of a sudden 124 units. And that was a huge jump to make. So I was very open to learning from everyone and anyone I could possibly get to spend time with me. I spent hundreds of hours with a property management team to understand even how to properly property manage a property. And that was inclusive of learning FHA laws, different ways in which operations are done from a day-to-day level on a property of that size. And then I took that knowledge and used my knowledge of construction to help us get to that point of maximizing the investment and executing the business plan. So in that particular situation, I was not the one who underwrote the property or even got to weigh in on the operational plan. I was literally handed a plan and told to execute it. I think that's a very difficult position to be in for someone who's now had to go through that. And I thought originally that I wanted to position myself as someone that people could come to and then, acquire a property, and then I would just take over and lead asset and construction management. But I learned very quickly that when someone does not underwrite a deal realistically, that people look at the asset manager as the person who is unable to execute and not the person who underwrote the property. So the way we do things today is completely different. So first of all, we do our own deals. That's number one. So we have more control. And number two is that I am heavily involved in the underwriting process because I know what I can do and what I can't do. You can't tell me to bump the rents, 30% of basis and increase occupancy by 10% all within 6 months. I know that's unrealistic. That's not possible. The only way you could potentially get to that is if you're heavily concessing the property, at which point, what does the rent gain even mean at that point? Because it's a moot point. So now the way we do things is we look at properties and we have a multiple stage process when it comes to underwriting. And we have checks and balances between not only the asset management mindset, the underwriter who's analytical and is not going to get tied into the emotional component. It's just a numbers point of view for that individual. And then also the property management team. We get buy-in from the property management team because I'm a firm believer that if your property management team is engaged and part of the underwriting process, the likelihood of that property actually getting to the pro forma is very good, as opposed to delivering a business plan and saying, now you got to execute this. It's the same principle as what I personally went through on my first deal, where I was given a business plan as an asset manager and told to execute it on it. So we just have a very different, I think it's more of a realistic type approach on managing these properties and a more personal approach on managing them, as opposed to just, set it and forget it type mindset.
Cool. So it sounds like you kind of transitioned to do more of all the stuff, instead of having somebody else kind of bring you in on the deal. You're doing a lot of it yourself. What were the main challenges that you felt like you faced when you were going through that transition, I guess, trying to build your own deals type thing?
I think I found myself competing against people who aggressively underwrite and unrealistically put, whether it is rankings, cap rates, people are forecasting. I've seen deals where cap rates are compressed on exit from acquisition. And it's just like, they know they can get away with it because most of the time investors aren't savvy enough to even look for that data or even understand what that means. So in terms of the, the equity they have investing in on these deals, they're not maybe as sophisticated as they should be. And I think that historically, if you look at large multifamily over the past, I would say 3-5 years plus, you've seen a lot of growth in this space. And I don't know. I think you could argue one way. You could argue a different argument. I personally believe a different thing than I believed, a year and a half ago, pre-COVID. But my belief at that time was that, are we going to constantly see this natural appreciation that has occurred? Are we going to constantly see all these new buyers flooding the market, which compresses the cap rates, right? Maybe we will. And maybe they'll look like geniuses, but at some point cap rates can only compress so much. So, and then you have to look at interest rates. So I think that the challenge is the same thing I realized in single family. If I compete against, and if I swim in a red ocean, it's very difficult to acquire properties. That is strategically why we went after high-end properties, because no one was going after them. It was very easy for me to say, for every 7 deals that I offer on, I get 1. So all I have to do is offer every single day of a week on single family, and I'm going to walk away with 1 deal. And we strategically did that. We knew that that was our yield. We didn't have to offer on 30 or 40 to get a single family. So if you take that same concept in multifamily and you say to yourself, okay, you're swimming in the red ocean again, how do you swim in the blue ocean? Well, do you find a way to get your cost of capital down and go after core assets? Do you go to new construction? Do you go after more expensive deals? If you go after more expensive deals, now your competition's changing. You're going from syndicators to family offices and, institutional funding where their cost of capital is less. So you have to take that into consideration. But ultimately, you kind of have to find what is the smarter versus harder way to work. Everything always boils down to the most simplistic concepts, but we get bogged down by all this noise that we forget common sense. And I think sometimes you just need to step away and realize, okay, I'm doing the most stupid thing right now by making it harder on myself. And I just need to step back and realize this is not a smart way of working.
Makes sense.
100%. And like you said, I think that whenever, especially when money's very cheap, I feel like a lot of people right now are trying to just get in on deals. And they, like you said, they're aggressively underwriting, making a lot of assumptions. And I'm interested to see how that plays out over the next 5 to 10 years. And it's unfortunate because, like you said, if you start taking investors' money, I mean, that's your fiduciary responsibility to protect their money. And so I hope that we don't see that happen. But given the amount of investment activity we're seeing in the market right now, and some of these cap rates that these properties are going for, I feel like it's almost inevitable that in the next 5 or 10 years we see, some sort of correction, or even if the next few years, really. That's interesting. So now that we've talked about, the actual deal process, could you tell us a little bit about the raising capital side? Because again, as a syndicator, you have to raise money from private investors. And could you explain to us a little bit about that process and maybe how you approach the capital raising side of the deal?
It's the timing of this question could not be more perfect because I've just spent maybe 4 hours today talking about strategically changing the way we do this. So I'm a firm believer that your purchasing power is directly correlated to your cost of capital. And pretty much a lot of people are going to underwrite deals pretty much the same. There might be a little bit of nuances, but they're going to be pretty close. And at the end of the day, when you get Invest in Final, I guarantee if people were very transparent about their cost of capital, we would find that probably number one is track record and whether or not the seller knows the buyer and relationships and all of that jazz. But number two is your cost of capital. That has to be one of the distinguishing factors on whether or not you get the deal. So historically, I've been a firm believer in constantly educating your investors because I want to protect the investors. And I know personally that if I was investing in something, I would feel more comfortable if I understood the process. But what I've come to realize recently is that I am creating a more expensive audience because they hear all this noise of upper teen returns on these investments, and those then become their expectations. And I'm a believer that if I tell you that I believe the return is going to be, let's say 12%, I'm going to work my ass off to get you there, if not above that, but I don't want to fall short. I never want to fall short. So to me, when you're seeing all of this compression in the market, you're seeing low interest rates, you're seeing compression of cap rates, you're seeing foreign capital come in and invest. You see that foreign capital is okay with just cash flow and not these huge sales that offset all of the low returns along the years. That really is very challenging to be able to compete against, especially when your audience expects a high return. So I'm starting to question whether or not going after real estate educated folks are the right people to invest in your deals because their expectations are just so much higher. They either personally invested in real estate before, they flipped houses, they know they can access alternative investments. So I think what we're going to see over the next, few years is we're going to see a lot of people change their mindset and try to bring in people who are not educated in real estate, who are not following bigger pockets, but they are very proficient in their own careers, whether they're physicians or lawyers or any other high earning professional that need another income stream or a way in which to diversify their retirement strategy or a way in which they offset their tax basis. So I think that is the overall strategy. I do think transparency is another key component to really educating your investors. And, I'm on a deal where I haven't seen a single financial the entire time I've been on this deal, and it's in year 3, and I haven't seen any financials on this property. I personally, any deal that I'm leading, so this is a deal I'm passively invested in, any deal that I'm leading, we provide financials on a quarterly basis, and they're monthly financials. It's just packaged quarterly. And we provide all of the information that we have access to. So inclusive of rent roll, balance sheet, copies of the bank statements. I think transparency is really important. Are there going to be investors who don't ever open that? Of course, right? But there is something to be said to having access to documents, whether it's investors who want to access that information or it's just that trust factor. It's the trust factor that you are being transparent, you're being honest and open with how you're operating a business. And they're partners on the business. They're entitled to see this information, is my belief.
Yeah, I agree with that. I mean, I think when you're raising private capital, keeping that trust and keeping that information. That's really interesting that you said you're in on a deal where you're a passive investor and you're not getting that stuff, and it makes you feel like you should be getting that stuff. Basically, it's always cool to come full circle with that stuff and be able to see it from the other side.
Yeah. And like, I like the idea of what you're saying, educating your investors as well. Cause like you said, I mean, there are investors out there that are intrigued by real estate, but they are not following the bigger pockets. Maybe they're doctors, maybe they're lawyers, maybe they're other people, high skilled professionals that understand the value, but again, they're not in it day to day like you are, Ashely. So being able to be that resource, and I see a ton of your content as well, and you're always coming from a teacher's mindset to kind of educate people about the process so they feel more comfortable with the potential of investing with you. So that's awesome.
Yeah. And so we know that you wrote the book, The Only Woman in the Room, and it's a compilation, I guess, of experiences of other women in real estate, right? And
yes.
We were wondering, I guess, could you talk a little bit about the book and then talk about how it's helped you to grow your real estate brand? Raphael is huge on this type stuff. He's wrote several books, and I'm always interested about it because I haven't done any of it.
I keep trying to convince him. I'm like, Luke, you need to write about your experiences.
So the book came together. I was at Dave Van Horn's Mid-Atlantic Summit, and Liz Faircloth and Andressa Gadelli, the co-founders of InvestHer, asked all the women in the conference to come together and for a lunch at this conference. So out of 450 attendees, there were 16 women in the room, and we all sat together and had lunch. And while everyone was meeting and talking, it was just like, you know, the saying where it comes over you like a wave. That literally happened to me. And I was sitting there thinking to myself, why are there so few women at this conference? I couldn't believe it. And then, you know, I looked at the speaker lineup, and there were very few women on, you know, the panels or even on the main stage. It didn't even matter. So I still remember to this day, it was in Philadelphia, and my husband and I drove home from the event. And I said, I'm going to write a book called The Only Woman in the Room, and it's going to talk about women in real estate. And I didn't know it was going to take the shape of having 19 other women join, but I started to like mull this idea over in my mind and identified 19 other women over the next year who just truly inspired me. And it didn't mean that they were, you know, 7-8 figure earning women. It was just people who had amazing stories to tell. They were willing to share their story, whether it be from a very tactical sense or very motivational aspect. And they were intriguing to me, and they were people that I believe should be on stage talking about what they were doing because they had great information to share. So my major reason for doing this was to give a platform to all of these women, because one thing I noticed is that a lot of times when you go to these conferences, the people speaking always have a book behind their name. So now I just provide an opportunity for 19 other women to have a book behind their name. And then, you know, selfishly, I have 2 daughters. I know one day when they're teenagers, they're going to be like, Mom sucks, and like, she's not cool. And I thought to myself, okay, well then here's 19 other women that my daughters could look up to and be like, you know, they're rocking it too. Like, this is something I could do. And, you know, there's someone that they could look up to and be inspired by. So it was really important to me. I think the best thing that has come out of this book, you know, I know the question you asked was, how has it like kind of propelled me? But it's actually motivated me on how many men have read the book and reached out to me. I fully expected a lot of women to be in support of this book and read the book and, you know, reach out to women in the chapter, because my whole goal was that everyone is able to pick up the book and identify with at least one person. And my goal was everyone, not just women, but everyone. But I was shocked at how many men have read this book and then reached out to me and said, I really resonated with this person. I can't believe how much good information there is on this process. I've been looking for something like this. So that has been really rewarding, because I think we're all part of the solution of just bringing diversity to real estate. And that is inclusive of age, gender, race. It really doesn't matter what component you look at, but I believe whenever you have a group of people that are diverse, they come up with the best ideas and the best solutions. And let's think about it. Real estate, especially housing, we have a housing shortage right now. We also have a high cost of build. There are a lot of issues within real estate that we're facing today. And I think when we bring a more diverse group of people into this world, those problems will be solved, and they'll be solved really, really well. So I'm just a huge proponent for bringing as many people to the table so that they can all benefit from all of the wonderful things that you can experience through real estate.
Awesome. Yeah. And I'll second her. I read the book. It's phenomenal. I really enjoyed the fact, I really enjoyed the diversity of the people that were in the book. I mean, they were all from different walks of life, different backgrounds, and they all had a reason why they got into real estate and how it's helped them achieve whatever their particular goals are, because everyone's goals are completely different. And I like what you said about the representation factor, because again, a big reason for someone to aspire to something is you see someone who's doing it and that you can kind of look to and say, oh, I admire that person or whatever else. And you kind of follow a path that they trail. And so finding someone that you can relate to on whatever it is, right? You read one of those stories and you say, this person, it really resonates with me. I'm going to try to see if I can pursue that. I think that's phenomenal. And I commend you for the fact that you did create that book and you continue to inspire other people with it. So
thank you.
Yeah. So one last question before we open up to the Q&A. So if you had to start all over again from the beginning, knowing what you know now, what's maybe the one or two or three things that you'd share with yourself?
So starting at the same time, or wishing I had read Rich Dad Poor Dad when I was like 12.
Exactly.
There was.
I think everyone wishes that. No, but let's say before you got into real estate, right? At that point, you could get back in a time machine and you meet yourself at that particular point. You say, okay, yeah, Ashely, XYZ. Take it away. Just kidding.
I would have gone harder. I was so like, I mean, granted, I had another job and I had other distractions along the way, but I think I would have gone harder sooner. I don't think I've ever met anyone who says that they wouldn't have bought more. I think I would have bought more. I think I would have held more. As much as I love flipping, there's great, just amazing memories with my dad. We could have also created those memories doing BRRRR, and we'd be in a lot, better position than we are. I mean, not that we're in a bad position, but, I definitely would have bought more. I would have gone harder, faster. I would have partnered sooner. I would have leveraged resources as soon as possible. I wouldn't have used my own money. I think using my own money was a shortfall and didn't teach me about raising money. And that's hands down my weakest. If you look at all the things that are involved in a real estate deal, raising capital for me is hands down my weakest point. And I think it's because I wasn't forced to do that early on. And I think if I had been, it would have educated me a lot sooner, because, everyone gets to a point where they need money. I mean, I say all these things, but I'm so happy with where I am right now. Like, I really, really am very content on where I am. I think I've achieved my why. My why from the very beginning was to put myself in a position where I could be there for my family at, any given moment. If I wake up and, it was this gorgeous day and I said, oh, I want to take my daughters to the beach today, I could do that. Or if they need me to come to school and pick them up. I wouldn't have that guilt. So I will have this big meeting this afternoon that I can't reschedule. I feel like I've gotten to that point. So I think my journey may have been different than what I originally, would have done if I could have gone back. But I think I've learned a lot that has put me in the position that I am now. So I don't know if I really would, like, you're making me think about it because I'm not like prepared, but I don't know if I've been asked this question before. But I don't know if I really would have changed anything. I mean, there's things I could have done better for sure, but maybe I'm just a glutton for punishment and I love learning the hard way. I mean, I don't know. So
sometimes it's like you can't learn unless, I'm kind of dumb. I can't learn unless if I do something wrong. I don't know. I can learn other ways too, but sometimes
I don't think anyone in real estate's dumb. So I don't think,
I know.
I know we just met tonight, but I don't think that's true at all.
Well, I guess what I mean by that is learning by doing is a great way to learn. And so sounds like
and it formed you into the person you are today too, because I'm sure if you hadn't gone through those experiences, you would have been different, right? So I can respect that answer. So yeah, awesome. Well, what we're going to go ahead and do now is we're going to go ahead and open it up to Q&A. So for those of you guys who are in the Zoom, feel free to chime away. I'll also be checking the Facebook group to see if there's any questions that come in through there as well. So Jake, I see you. You want to ask a question? Jake's a regular. He comes quite often. I put him on the spot.
Yeah, Ashely, I apologize for the background noise. Couldn't miss this one, but I'm kind of on the go. But I follow a little bit of your story, and I'm trying to think about specific questions. You might have mentioned this at the beginning. I missed the first few minutes. But where are you typically looking to invest right now? Is there any particular areas? And what are you looking for more of these days, maybe outside of investors? What could you use more of on your team?
Yeah, so we have historically looked in Houston, and we still really like Houston. We like a few other markets in Texas that we've started to expand into, I guess, so to speak. And then we have been meeting over the last 2 weeks to pick another market. So full transparency, we did look at Boise. We talked about this a little bit online. We love Boise. Boise is a great market, but it's not great for existing product. There's very few existing product on the market, and in part because there was a building moratorium that stopped building for a while. So there's a huge housing shortage there. So new build is the play in Boise, hands down. I'm not giving away like any top secret. If you go to that market once, you can tell you need to do new build. So that would have been our market. But we don't have the bandwidth. So to your second question, with respect to what are we looking for infrastructure wise, we currently don't have the bandwidth to add that with acquiring existing. It's something we're interested in doing in the immediate future when we have a better grasp on what we're doing and have more infrastructure on what we're doing. And then also to branding awareness, this speaks to the deficit of using my own money and not really focusing on the importance of building your reputation. And I mean, I think I say that, but my partner is Jay Scott, and Jay and I both have, I think a solid foundation, but I don't think we've done a good job of converting people because we haven't really spent a lot of time asking. And we've spent more time operating and, managing the real estate as opposed to marketing. And whether you have a good following or not, you should never discount the value of marketing. And that's something we haven't done well. So finding someone who can help position us better and really just take us next level, because I mentioned before, your buying power is directly correlated to your cost of capital. I think that is also probably directly correlated to your branding and your awareness. I know a lot of people who have funded deals entirely through Instagram followers. and LinkedIn followers. And that's something that we have not done a really good job of. So that's been a focus over the past, I would say, 2 months of trying to put more infrastructure in place to help us get there. So we're building out stuff, but we're not even probably a 10th of the way down that road yet.
I appreciate you saying that, because I think it's very easy to get caught up in that early on, to say I need to go ahead and start building the brand, because I think you see a lot of people take that approach, is how do I gain my following to then let that lead to other areas of growth. And in my opinion, people do that too soon. You see that a lot. I'm definitely a fan of being a better operator and then growing the brand. It's probably hard to do that the other way around, but definitely one of those leap of faith things that I think is tough to do until you feel like you have the credit behind you. Yeah, there's no answer there probably, but
no, I think you bring up a great point, because we just launched a apartment coaching program in the beginning of May, and it's in beta. So it's very, very small group of people. We have 30 people, but what's interesting is it's all centered around building or buying large multifamily properties. And all of these individuals are experienced real estate folks, but they aren't experienced in the large multifamily sector yet. And we're helping them get there. But what's interesting is how many people have talked about how do I build my website? And it's like, well, you haven't underwritten a deal yet. And I'm not trying to say it's not important. And maybe I'm wrong, because that's something that's like my deficit. But at the same time, I think, you only have so many hours in a day. And I don't know if necessarily it takes a long time to get a property, but I think starting to understand underwriting and market selection and your buy box and all of those components, I think need to be, ironed out first before how do I build my website? So, I'm not trying to say it's not important. I'm not trying to say that you should put it off until you have a deal under contract, because that's way too late. But the conversion rate is 200 to 1. For every 200 deals you're looking at, you're lucky if you get one. So, building the website, I don't know, is the first step you should be doing, personally.
Yeah. No, I will say, I think that's a great point. But one thing I wanted to add to that, because I've talked to Jake about this too, the idea of documenting. So for example, if you're doing a process, why not record yourself doing it? And post it online, talk about why your experiences, because at the end of the day, you're showing people about you're learning through doing, and maybe someone looks at that and say, oh, cool, this guy seems to be knowing what he's doing because he's going through the process of learning about this thing and he's providing unique perspective, or, whatever else. And so I think in that front, you don't necessarily have to be an expert. As long as you provide a unique perspective on what you're thinking as you're going through the process of learning, I think in and of itself adds value to people. And then you get known through that as well. So I don't know. I've been, Jake's got some really cool, he's been doing some cool stuff over the last year or two. And I've been kind of encouraging him to,
I think you should definitely do it. But I also think too, what you're hitting on is the authenticity.
Yeah.
So by Jake showing his journey, or I don't know if it's Jake's journey that you're referencing here, but
yes,
by showing one's journey, I think that builds credibility, because someone is deemed authentic and they're being transparent and honest about their journey. And in and of itself, you'll gain followers. But what I'm more speaking about is when, I was in another coaching program and I saw the same thing. I was in a coaching program. I had 2 deals under my belt. Some of the other people hadn't even done a single real estate transaction, period. I'm not even talking about large multifamily. I'm talking about single family. They had in house hack. They had in wholesale. They hadn't done even the most, entry level. And I don't mean that in a negative connotation. I mean the most common entry level way someone gets into real estate. And yet they're talking about, well, how should I build my website? Should I build it on this platform or this platform? And it's like, if you want to spend hours doing something, don't spend it on building your website. That's more where I'm coming from.
Sure. That makes sense.
So
I think that goes right into what you were talking about with your purchase power is, and therefore that affecting your cost of financing and how that plays a big role into the competitiveness of the market right now. It plays into, well, if you want to get to the point where your purchase power is greater, but maybe you don't have that credibility yet, where is the time to partner? Are you doing that too soon, right? To go get that purchase power through a partner? I don't know your thoughts on that. If kind of looking back again at your early self, would you have gone and got the purchase power earlier before you maybe had that credibility, so that you could learn faster, grow faster? And to your second point earlier about doing more faster, I don't know if you have thoughts on that as far as partners and increasing your purchase power before you try to jump into bigger deals.
So when I started in multifamily, which wasn't too long ago, but it speaks to policy and how much policy has changed, is with the SEC regulations being so stringent. People were very reluctant to do the 506C type offerings. They really wanted to do 506B because it's friends and family type investors, a pre-established relationship. And they felt more comfortable that way. I, from day one, was a 506C supporter. I was accredited investors only. And the reason behind it is believing that you have less liability if a third party is vetting accreditation versus you vetting a family or friend to say whether or not they're sophisticated. And I received a lot of negative pushback from that. People thought it was crazy. And today we're in a situation where most people are doing 506C because they realize that they can advertise and there's more people outside of their friends and family network than the other way around. And also too, we're in an environment where the SEC is now reviewing the way in which capital raisers or people who are raising money that do not have broker's license in which to do so are being able to be compensated. So that's a discussion that 3 years ago, I know came up and people said, there's no way that'll happen because too many people will exit the stock market and lobbyists will come in and they will have a huge problem with how much money is exiting the stock market. So this is a safeguard that is really, what's going on behind the scenes. I think that if you're in a situation where you are trying to figure out how do you raise the capital, and looking back on what I was doing before, I was thinking the best way is through that 506C route. Today, I still believe it's the 506C route, and I don't see how I would change my line of thinking unless the definition for 506B versus 506C changes. And I also think too, because of the way that there was such a negative connotation towards capital raisers, I did not, shockingly, I'm kind of a little risk adverse. Like I don't want to put myself in that situation. And I think it was very risky just to raise capital, especially when you were in that 506B environment. And also too, knowing that if one person says the wrong thing at a meetup, and, someone who doesn't know the person finds out, that it could come back. So the environment changed. Today, I feel like if I was in a situation where everyone's doing 506C deals, I probably would be more inclined to say, raising capital is not such a bad gig in terms of the risk profile. Let me learn another component. So, because the whole idea is you have to do something else besides, just raising capital. For compensation, it can't be directly related to the capital you bring to the table to close the deal. But that's why I think it's not necessarily an answer I can answer today because the environment changed.
It's a great response. I think it's one that everybody is trying to figure out, and there's not an exact answer, and that's why everybody says something a little different. But you look at like Investor Grow Bread and people that have made that leap recently, everyone tends to go that way. They eventually get to that C route. It's just a matter of how big of a leap they make to get there. And so that's a commonality I see.
Well, to me, it's the second easiest position on syndication. The first position that's the easiest is someone who's a loan guarantor. That is hands down the easiest. If you find really good operators and you partner well and you have a good net worth and good liquidity, like there's no better gig. You're literally signing on a loan with a group you trust, as long as you pick the right people, with the group you trust, and you're being compensated for it. And typically very, very well. I mean, the typical breakdown that we see in syndication, and if this is across the board, you look at all the major syndicators, you see someone who's doing the loan guarantor position around 10%. You're seeing someone who, you know, the whole capital stack typically has a 30% carve out. And you see asset manager having a 30% carve out. An asset manager is someone who's with the deal, it could be 10 years out, working every single day. But the people who raise capital, who have, you know, they're raising capital for what, 30 days, maybe 60 days, and they're getting the same compensation carve out. That's typically how people have it structured. So that's why I would say that it is, you know, people who are raising capital are probably pissed at me for saying this, that I'm saying it's the second easiest gig. But if you look at just work, like time in, you know, how much time are you putting in? How much effort are you putting in? I think it definitely falls under the work smarter, not harder bucket.
Thanks for the candidness and just openness there. I mean, I think it's important to hear that from people that have done it and are doing it. To know it's a good place to be. Obviously, I think a lot of capital raisers might be mad at you, but they know it takes a lot of work to get there, to be able to do that. And so that's why you're compensated well.
Yeah.
Yeah, it's not that I think it's an easy thing to do, but if you look at the deal cycle, it's one of the shortest truncated roles in the deal.
Sure. Sounds like what I want to do.
Right.
I would do that if I had enough money.
Well, you just have to have a network of people, right? You just have a big network.
Yeah.
That's cool though.
I think we have, it's right around 7, so we want to keep it right around an hour. I will have enough time for one more question. If anyone wants to chime away, I'll check Facebook real quick. Okay. Awesome. Looks like we answered all the questions. So Ashely, no, I really appreciate you stopping by again. Hearing your unique perspective on the space and, you know, getting a feel for your understanding of how you started with the book in particular. Because like I said, it really was a phenomenal book. And if you guys haven't had a chance to read it, I would highly encourage you guys to grab a copy. It is on Amazon and as well. Luke, do you have anything you want to add?
Just want to say, Ashely, thank you so much for coming. I've got a lot of stuff to think about that you talked about, and I really appreciate all the info. So thank you.
Absolutely. Thank you both for having me.
Yeah, of course. And how can people get in contact with you if they want to learn more about you or they want to reach out to you to discuss collaborating in some way?
Yeah, so you can follow me on Instagram at Bad Ash Investor. You can link to all of my sites through badashinvestor.com. And then in terms of investing with us through passively investing with apartments, you can do so at bardowninvestments.com.
Awesome. Great. Well, thank you all for stopping by. As always, it's always great to see you all on these virtual meetups, and we'll see you guys next time. Thanks, Ashely.
Thank you.
Ashley.
Thanks.
See you guys. Bye.